This lesson is going to show you an advanced range trading concept. I'm going to show it live on the charts, and it's going to build on the theory you've heard from earlier. So I've talked about how ranges form, the nature of a range, talked about them through the lens of Wyckoff theory, and now we're going to apply it to the charts. Not every range will form and look like a Wyckoff schematic. That doesn't matter for us to trade. What we know is, the rule of markets is that they trend, then they consolidate, then they trend again. So in that consolidation, a range will form, and if a range forms, we can trade it. We also know that the market spends more time in a consolidation phase than it does in a trend, so it spends more time ranging, and therefore we can get more opportunities in ranging markets than we can in trending markets. So let's do it. I'm using bar replay to watch one form as if it were in real time. We can talk through it as it forms what you want to look out for. There are rules, 4 simple rules for range trading that I have. The first one is you want to see a 75% retracement of the previous leg down. Okay, so that means you let price form a swing high, which is here. So this was the previous swing high. Then, as you'll see, price breaks below it. So we are still in a confirmed downtrend. For continuation of a trend, price should not retrace more than 61.8% generally. So if price retraces, meaning if it bounces up more than 75% of this leg, we can consider it to be the beginning of a range. So let's wait for price to bounce. Price is now bouncing. So as price is bouncing, we want to get our fib tool. We want to put it from the high to the low, and there we have our range. So my fib tool is set with these settings: 0, 0.25, 0.5, 0.75, 1, 1.2, and minus 0.2. The reason for that is because ranges form in a linear fashion. So you have 0, a quarter, a half. The half is always a good turning point. 3/4 and 1. The reason for that is because your 0 to 0.25 is where you can consider it to be discount. It's cheap. And then 0.75 to 1 is your premium. It's expensive. So you buy discount, sell premium. We'll get onto that in a moment. Right now, we have not got a confirmed range. We are waiting for a close, candle close, which is why I'm on line chart. It's easier to mark them out on line chart as you're watching. As soon as we get a confirmed close above 75, our range is set. There we have it. This was the close of the range. So this now means we're in a high probability range. This is not range high. So now all we wanted was this retracement. We now delete this. Now our range will form from the bottom to whichever top we have just made. Okay? So our potential range low is here. And our potential range high at this point is here. I say potential because we need one more thing. We need a market structure break to confirm that this is in fact a range high. So I put this in a dashed line. This is the market structure level. You'll know from the market structure lesson that you have a low, you have a high, you have a higher low, you have a higher high. So if price breaks below this dashed blue line, that will be a market structure break, meaning it is not trending. And that gives us the second confirmation that we need that it's in a range. First confirmation is the 75% retracement. Second confirmation is a market structure break, which confirms we are not uptrending, and it confirms our new range high as being here. Let's see if that forms. Of course it does, because I'm on replay mode. And so, we have a market structure break. Good. Now we can consider this to be our range high. Range high. And this is how you mark it in real time. And then we have range low. Now, what do we want to do next? Next, we want to look at our fib tool. Take it out, drag it across. Should drag it from top to bottom so I get it correct with the 0 and the 0.25. There we go. So now we have range low, range high. We have 0 to 0.25. That is our discount zone. That is where price is considered cheap. So we want to mark that. Mark it in green. We've got our range high, 0.75 to the top. That is our premium zone. We've set now our discount and premium zones. The last thing I need to remind you about is the 20% rule. I've touched on this in other lessons. The 20% rule relates to ranges, and it is putting 20%, as you would imagine, either side of the range, and that is the maximum deviation you can have and will remain within a range. Okay, so if price goes below the range low, but doesn't close below 20%, it is still considered a range. Same with the high, and this is where you can target high probability liquidity sweeps, fake outs, and the such. So, let's play it on. We can now look, for the first time, I would say it's okay now to look at the candlesticks, because there's one other thing we want to add on, which are liquidity sweeps. So now putting the candlesticks back on, you also want to mark the wicks, because range low is where the close is, but your candlestick is where the liquidity is. So that's liquidity. And so your candlestick wick will be where liquidity is, because traders put their stop losses below wicks and above wicks. And here was one that was already completed. So we had liquidity here which got swept. You see that we set our range high, we came down, we swept above it, and then we broke down. After breaking this structure level, we then hit into the discount zone. So after this break, your next candle, you could have bought here if you had a setup. It is now valid to buy, even that wick into there, it is valid to buy if your system tells you can. It doesn't mean you just automatically buy there. Of course not. But let's play it on and just see how price respects within a range. Okay, you've range low, you've got liquidity, you've got the 20% rule being respected so far. You see that? We had range high, it deviated above it, it did not go above 20%. We haven't tested the low end. And so as we play it on, we see that there was an initial bounce. So here it held, it pushed right up into our premium zone. So it went from discount all the way up to premium. There is one trade that could have been had if you had lower time frame entries, right? From your 25% area up to your 75%. It then a strong rejection. We then push down towards range low. We see the price holds the range level. It sweeps the liquidity. Notice this. So it holds the range level and it takes out the liquidity and it respects the 20% rule. So far, a very strong and valid range. We let it play on. Price now moves up through the range and towards the other side. We then reject one more time as I drag this across, just to make it clear. We then reject off of our premium zone one more time, which leads to a strong move down and a break of the range. So all the way through here, we have the principles that we look for. Number one, we started off with the most important thing, which was a 75% retracement of the previous leg. That gave us our first clue that we were in a range. Second, we got a market structure break, which confirmed that this was our new range high. Third, we set our discount and premium zones, green and red. Fourth, we look for liquidity sweeps. We got one here and we got one here. Then you are able to trade within that. So you can take that and make trades off it. Maybe you trade after liquidity sweeps. The best time to trade is when you have a liquidity sweep. So here, we sweep the low, we come back inside, you don't touch it yet. It comes back and it retests the discount zone. So anywhere in here, you had a sweep, you then retest the discount zone and you trade it to the premium zone. And maybe you leave some on and possibly trade it towards liquidity at the highs. That's up to you, personal preference. This isn't about building the full strategy for you. This is showing you how to trade a range. But what you would do is you would take your position tool. You know you had a sweep. You're getting entry somewhere on the retest here. You know where your risk is defined because there is a low that was set. You're trading it up to the other side, which gets you positive risk reward between 2.75, 3.25, a nice range trade. These repeat over and over and over again all the time on different time frames. So you take the principles, take the 4 rules, use them, put them together, test many things out, and that is how you trade a range.